Hi guys, I'm Tyler Laundon, Chief Analyst of Cabot Small Cap Confidential and Cabot Early Opportunities, and I'm here with your Cabot Weekly Review. Recording this just before noon Eastern on Friday, September 23rd. And we got exactly what we expected when it came to the Fed this week. That's really what the market has been focused on. They hiked by 75 basis points on Wednesday. Fed Chair Jerome Powell's messaging was pretty consistent with what he said back in August in Jackson Hole. So, the short version continues to be they're going to do whatever they need to do to get inflation under control, because not doing so would be worse than the alternative. On the surface, of course, that makes perfect sense. We can't have houses going up double digits month over month, price of a used car being higher than the price of that car brand new a year ago. Price stability really is important. But the market doesn't really like the idea of the higher for longer theme when it comes to interest rates, especially when the Fed doesn't exactly have control over things like global supply chains, what happens in Ukraine, some of those things that, they just can't twist with interest rate and balance sheet management. So, heading into Wednesday, stocks were mostly drifting lower anyway. The selling has picked up afterwards. I think investors are clearly factoring in a higher chance of recession now. That's what we're hearing from a lot of the big banks. And I think some of that comes down to the changes that were in the committee's forecast that weren't necessarily positive. Most notably, the median Fed funds rate this year that the Fed sees now goes from 3.4% to 4.4%. And for next year, it goes up from 3.8% to 4.6%. And their expectations of GDP for next year also drift lower to about 1.2% from 1.7%. So not a recession in their forecast, but definitely, again, higher for longer when it comes to interest rates and less GDP growth. On inflation, they use the PCE measure. They now expect 5.4% this year and 2.8% next year. So, of course, they do expect that what they're doing with interest rates is going to cool inflation down. I think, when you step back and you listen to all this and you watch the market on a day-to-day basis, it's pretty easy to get pretty bearish and think it's all over. It is, however, hard to invest with that mentality. Of course, it depends how much money you have invested, how much you have on the sideline, your risk tolerance, age, all those things. But again, just stepping back, a few things to think through here. Best to have a plan. So here's something of a playbook in terms of what we can see when it comes to the Fed, which I think is going to have a lot to do with how the market acts in the back quarter of the year. Of course, that's what we're all kind of expecting. Everything's being manipulated now by the Fed. So the Fed's current target rate now is 3 to 3.25%. That's after Wednesday's hike. So with no meeting in October, we should expect another 75 basis point hike in November, and then another 50 basis points in December. Granted, we're going to get new data over this time frame, so inflation, employment, all that. So that could change things, possibly for the better, maybe for the worse. We'll just have to wait and see. But the bottom line, as far as what we're expecting right now, by the time we get to New Year's, the Fed target rate is going to be in that 4.25 to 4.5% range. And then maybe we get a couple more 25 basis point hikes in the first part of 2023. Now, again, stepping back, looking at what is going on around us, the price of oil is now less than $80. It's up only around 10% on the year. Housing seems clearly in a recession, 6.3% mortgage rate on a 30-year. I mean, if you talk to a mortgage broker now, then, those guys are not psyched. Definitely some areas of the economy being hit. Travel still seems to be pretty good. Bookings through VRBO, Airbnb, a lot of the cruise lines look to be okay. International travel is picking up. So that kind of gives credence to this rolling recession idea. Although, of course, we're in the early stages now of what's happened since this last rate hike. So we'll just have to see. Bottom line, when you step back, it does seem as though what the Fed is doing is helping it achieve its goals. It's just a really, really messy process. And of course, the concern and the risk is that they overshoot, and this whole soft landing idea, like this light recession, no recession, or rolling recession, that all goes out the window and we get a hard landing, so a full-blown recession. And that is what the market is trying to come to terms with right now. The risk of that is higher. So given that, in the short term, I do think that the risks of the market falling below the June support zones have gone up. Hopefully that doesn't happen. We're going to go through some charts here in a minute, look at where things are at. If we can hold here, odds go up that we could be range bound through October, November, hopefully through the end of the year, assuming the incoming data isn't overwhelmingly bad. Again, when it comes to stocks, this isn't the time to be a hero. Picking a bottom is notoriously difficult. But I do think that as we step back and we look at where we are right now with the market indices kind of approaching their June lows, it's natural to look at things and say, okay, if we can hold here, this could be a buying opportunity. So we're going to take a look at some stocks that might work with that theme. As always, these aren't formal recommendations, and given how the market is acting, any of these stocks that I'm going to talk about could look far worse by the end of the day today than they do right now. So, it's up to you to use some common sense and, of course, balance things with your own risk tolerance, time frame, and all that stuff. So, the chart that we have up here, this is, of course, the 10-year note, and as you can see, it's been going higher. This is the yield. So we moved above 3.5% early in the week. We're at about 3.7% right now. So not a huge surprise given the Fed's hike. But, this trend line here going back above where we were in June is kind of key. And that's why we're looking at the major market indices approaching those June lows right now, just trying to digest this and figure out what's going to happen with the economy. So let's move on to the S&P 500. As you can see here, we are at 3694 as of right now, 11:37 Eastern, and that's not that much above 36 from June. Only it's real close. That's the S&P 500. S&P 600 small cap index is intraday today down a little bit lower than the June low. And the NASDAQ looks about like the S&P 500, so a little bit above its June low. But clearly, none of those indices are looking all that hot. Moving on to stocks. Again, going with this theme of stocks that are approaching support zones, not getting fancy here. So this is Microsoft, 32% off of its high. But here we are right around this 235, 240 area. It's at 239 right now. For the last 3 days, Microsoft has been holding pretty steady here. We got almost a 10% dividend increase. So this is a name that, if you're interested, you might take a stab at it here. And of course, if it breaks lower, then that could be a stop loss, trigger, or, that's up to you. But Microsoft, and then moving on to Google. So Google's kind of interesting. It slid below its low of 102 from, this one was actually in May. So May 24th was the previous low for Google. And last 3 days it's been down. But, not like jumping down 3% a day, just a percentage point or so. So not altogether a different thesis there in terms of trying to buy near this support zone than with Microsoft. And then CVS here, not at a low, but definitely at a support area, right around 97, 98. And this is the low range from when the stock gapped up back in August, on August 3rd after earnings. So we're right at that level right now. And I have an alert here in case it goes below 97 and change. But again, right near a support zone, kind of interesting. And then Accenture, ticker symbol ACN. So they reported a couple days ago, right again near support here. They're down today, just below that support area. I think you can give a little bit of wiggle room with these stocks, but not too much, of course. Also a dividend increase here from Accenture. So moving on to a couple of higher growth names. These guys were doing okay, and they're still looking all right. They're back around the 50-day line here for Netflix. Of course, we all know the story here, but the stock has been stronger than you would have thought if you had just put Netflix out of your mind. Back by the 50-day line here, kind of interesting. And Snowflake, another one of these big technology companies, extremely fast growing. I think a lot of people were watching it, and then the stock tanked the first half of the year, and they kind of forgot about it. But here it is; it's been doing okay. Higher highs, higher lows, topped here right above 200, around 205, and it's back around its 50-day line here. Hopefully, it can hold, and if the market holds up above those major support areas, then could get a little bounce in Snowflake. And then Pinterest, again, I think a lot of people have written this one off, but here we have a long drawn out decline, bottoming process here potentially, and then a move up and above the 50-day line with a pullback to that moving average line today. All right, some smaller names. So Sprout Social, I'm not trying to sell these charts as looking great. I'm just, again, going with this theme of near support. So Sprout has been making an effort at a comeback. It's been topping out just below 70 and pull back to the 50-day line here. The last 2 or 3 occurrences, it's been able to work its way off of that. And it was above the 200-day. We'll see if it can do that again. Elf Beauty has been surprisingly strong. I just put this one up there as an example of not every stock out there looks like garbage. Elf Beauty has been doing okay, $2 billion market cap, and a little bit of a pullback here. If this gets down to the 50-day, right in here, it could be interesting. There's a whole story here with, people that might be pulling back on big ticket spending, but giving themselves the luxury of makeup and whatnot. So that's Elf Beauty. AXNX. This is a med tech story that is interesting. I've been following it for a while. Stock was doing great. We weren't able to get through 80, pull back here, but now we're back here to around 64, 65, 66 area, which is where it peaked back in April. Be nice to see AXNX hold here and trade in a consolidated manner through a couple of weeks, maybe get back up to 70. Exponential Fitness, another stock that was doing okay, and just today has fallen below its 200-day line. It's funny, just an internal Slack message from a coworker just came through asking me about Exponential Fitness. So here we have it, just below the 200-day again, at the 50-day. And again, I think you can give a stock like this a little bit of wiggle room, but not too much. If it goes below the 50-day here, then that could be a signal that this gap from the earnings is gonna fall apart. Mission Produce, AVO, ticker symbol AVO, so they do what you would think, they grow avocados. Seems like it would be a relatively low risk stock. Had a nice move here in August, pulling back, and now in this $14 to $15 area. See if it can hold there. In Structure, ticker symbol INST, an ed tech software company, market cap just over $3 billion. Was doing pretty well in June and July, topped just above 25, right around the 26 level, and back to the 200-day line. Seems to be consolidating now. A couple of biotech names for you. CYTK, CYTK, market cap of $4.3 billion. You'll have to dig into these if you're interested in their stories. I just want to get through the stocks today. A little pullback to the 50-day line here, and not that much above where the stock peaked at the end of last year. If it can hold there, the market holds up, could be interesting. And then Xenon Pharma, ticker symbol XENE, market cap of $2.2 billion. Stock doesn't look all that different from Cytokinetics. although it is a little bit below the 50-day here, but hopefully finding support right around 35, which was a high at multiple times throughout the first half of the year. And then last here is SIBN, ticker symbol SIBN. Looking for a name here that was coming off the bottom, a medtech player that, you know, wasn't as strong as some of the other ones out there, but it got back to its 200-day line, stalled there right around 1850, and it's back to the 50-day here. I'd like to see a name like this, you know, get back above the 200-day before I would do anything with it, but it is on my radar. And again, following this theme of dropping to a support area right here at the 50-day, right around 16, where it found support in early September. That's SIBN. And I should say, last but not least, two names here. So this is these are long-term care and primary care providers. If you've been following the news, you've probably heard that a lot of these smaller players are being picked up by the bigger ones. So this is Cano Health, rumored acquisition target by CVS and Humana. So getting a nice pop here. If you wanted to speculate, trying to end on a high note here with stocks that look good, another player in this space is Oak Street Health, OSH. You know, there's no rumored acquisition here, but again, it's kind of in a similar place to Cano, and so it's hard not to speculate a little bit. All right, guys, that's it for me. Hopefully the market can hold here above its June lows. We can close out the week and start fresh again next week. Hope you have a nice weekend and enjoying the beginnings of fall, and we will be in touch again soon. Take care.